These are 10 of the top dividend growth stocks right now for 2025. Together, their yields beat the market, and combined they're worth more than $1.8 trillion. In this video, we're covering all of them and saving the best until the end, starting with number 10, D.R. Horton. D.R. Horton trades in the US under ticker symbol DHI. It's a $47 billion market cap, and it's just $12 above their 52-week low. They're one of America's leading home builders. The company only pays a 1.08% dividend yield, but they've grown this 11 years in a row, and they have plenty of share buybacks to give them a 4.5% shareholder yield overall. D.R. Horton's also owned by 3 super investors, and this is led by Greenhaven Associates with a 7.6% position. The company trades roughly in line with historical multiples, and they're priced well below a DCF. Still, though, home building is a cyclical industry, and today a GF value only comes in at $129 per share, or 14.5% below their current stock price. We're looking at the top dividend growth stocks in 2025. Most of these businesses are deeply entrenched with well-established moats. Based on the huge amount of money they're paying out to shareholders and the fact that it's growing, they may be interesting companies to look at. Plus, some themes on this list are going to stand out to you and may surprise you. Keep in mind, though, the video isn't financial advice. It's not a buy or sell recommendation of any security. Use common sense and do what's right for you. Now, let's keep looking at our list. Next at number 9, we have FedEx, ticker symbol FDX. This is a $66 billion shipping and logistics company that's trading in between its 52-week high and low. FedEx pays a 2% dividend yield that they grew 9.5% last year and have grown 4 years in a row. They also buy back shares and have a 4.5% shareholder yield as well. 9 super investors own FedEx, led by Mason Hawkins of Longleaf Partners. He has nearly a 7% position. Today, FedEx or Federal Express trades slightly below their historical sales, yet they're out slightly ahead of their cash flows and their earnings. That's why a GF value comes in at $250 per share, or down 10% from today's prices. Start number 8 is where we get into some dividend royalty. This is Cintas, trading under ticker CTAS. It's an $80 billion market cap, and it trades $30 below its 52-week high. Cintas is a dividend aristocrat, soon to be a dividend king. They've grown their dividends 44 years in a row, despite just paying a 0.8% yield today. This includes 16% dividend growth in the last year alone. That's huge. Despite strong dividend growth, no super investors own this stock. Lee Ainsley last sold out of it in the second quarter of 2024. Cintas provides cleaning and sanitation solutions to businesses. Today, it looks like it's stretched beyond its numbers, where it's trading well above their sales, earnings, or their cash flows. Their GF value reflects this as well. This comes in at $143 per share, which is up 38% from their stock price and comes with a significantly overvalued warning. Then Lam Research comes in at stock number 7. This is a $103 billion company that trades just $10 above their 52-week low. They trade under ticker LRCX. Lam pays a 1.15% dividend that they've grown 11 years in a row and by 15% last year. Lam's one of the largest semiconductor wafer fabrication equipment manufacturers in the world. Its top customers are the who's who in terms of making semiconductor chips. They include TSMC, Samsung, Intel, and Micron. 4 super investors own Lam, and this is led by Chase Coleman and David Tepper. There's a lot of growth being priced into this business, and they trade well above historical multiples, but they're still coming in below their DCF based on either their earnings or their cash flows. Semiconductors are a cyclical industry, and that's shown in their GF value and in their stock price. Today, this only comes in at $61 per share, which is down $30 from their current stock price, although this is projected to increase in the future. Stock number 6 is Starbucks, ticker symbol SBUX. The worldwide coffee chain is a $108 billion market cap that trades just $7 above their 52-week low. With the newly brought on CEO of Chipotle, Starbucks may have new life breathed back into it. The company pays a 2.6% dividend yield, which beats the market overall. They grew this by 7% last year and have grown it for an entire decade. There are 9 super investors who own Starbucks, and this is led by Chris Bloomstrand, one of the world's leading experts on Berkshire Hathaway. He has nearly a 4% holding in the company. Today, it looks like Starbucks is trading pretty attractive to where it's been priced historically. Though their cash flows and their earnings don't quite match this is a very strong branded company that may justify this. Their GF value comes in slightly ahead of their stock price, and it looks like the company is trading around its fair range today. Now, into the top 5. At number 5, we have TJX Companies. This is the parent company of TJ Maxx, Home Goods, and Marshalls. It's a $137 billion market cap that trades just $6 below its all-time high. TJX grew their dividends 12.5% last year and currently pay a 1.2% dividend yield. This includes 4 years of dividend growth since the pandemic. Only 2 super investors own this stock, and both have very small positions that they reduced last quarter. This company is a long-term compounder, and they're a market leader since the global financial crisis. In that time, their stock price is up more than 20 times. Yet their valuation seems somewhat stretched today. The company's trading above their historical sales, and they're way above their earnings or their cash flows, even when projecting future growth. Their GF value comes in just shy of $100 per share, and that's down 24% from their current stock price. Another retailer is next at number 4, and that's the home improvement company Lowe's, ticker symbol LOW. This stock trades $23 below its 52-week high, and it has a $147 billion market cap. Lowe's is our first dividend king, growing their dividends 53 years in a row and today paying a 1.8% dividend yield. They also buy back a lot of shares and have over a 5% shareholder yield as well. Lowe's is owned by 2 super investors, including Tom Gaynor of Markel Group with a 1.7% holding. Home improvement retail looks like there's more growth being priced into their future. They're trading ahead of their historical sales, earnings, and cash flows, but just about in line with their Peter Lynch value. So the market doesn't seem to think this growth is going to come too quickly. They only have a $214 GF value, which is down 22% from their current stock price. At number 3, we have Intuit, ticker symbol INTU. The $170 billion company is in between its 52-week high and low. Intuit's the household name software company behind products like QuickBooks, TurboTax, and MailChimp. Although it only has a 0.7% dividend yield, they've grown this 13 years in a row and by 15.5% last year alone. 9 different super investors own this stock, and this is led by a 13% position from Lindsell Train. Intel's long been thought of as a growth company, yet even today they're trading above their historical valuations. Their stock price is more than double their projected cash flows and their Peter Lynch value. Yet they have some deeply entrenched brand name products. This helps give them a $640 per share GF value. That's roughly in line with their current stock price. Stock number 2 is our final retailer. It's the other home improvement giant, the Home Depot, ticker symbol HD. This is a $407 billion market cap that trades $20 below its all-time high. Home Depot has grown their dividends 15 years in a row and currently pay a 2.2% yield that they grew 7.5% last year alone. 7 super investors own Home Depot, and this is led by Tom Gaynor, who also had Lowe's in his portfolio. No surprise, this is a long-term compounder. They were one of the top companies in the market in the late 90s, and that's still the case today. Though they had a 15-year stretch in between that was pretty rough. Home Depot trades slightly above their historical valuations and what it looks like are projections for their growth. They're well ahead of their current cash flows and their earnings. They've had a run-up in their stock price from the middle of 2024, and today this is about $50 above their GF value, or about 20% higher. Now, the top dividend growth stock on our list has one of the deepest moats in the world. This is Visa, ticker symbol V. The $627 billion payments giant is at its all-time and 52-week highs. Visa is not always thought of as a dividend growth company, but they've grown their dividends 17 years in a row, including 15% last year alone and giving them a 0.75% dividend yield. Visa is the 4th most owned super investor stock, and this is owned by 25 of them. That's led by Triple Front Partners, Chris Hone, and Chuck Akre. From when the company went public during the global financial crisis, its stock price is up more than 30 times, and they've given shareholders all these sweet dividends as well. After growing for decades, today though, Visa's trading above their historical sales multiples. They're also double their projected free cash flows and their Peter Lynch value. This includes them being way ahead of their DCF based on either their cash flows or their earnings. Yet Visa has one of the deepest, widest moats of any stock in the world. That's why a GF value comes in at $30 per share, which is down $20 from their current stock price. Let me know if you want to see a future video on any of these businesses. Having a few home retailers on this list, an industry known for change, was a major surprise. If you enjoyed the video and you want to support the channel for free, click the first link in the description. That will take you to Global Values affiliate Interactive Brokers. Thanks for watching and have a great day.